In this video, we're going to look at what I call Mortgage 101, essentially the basics through to the intermediate items and terms that you should be aware of should you be thinking of taking out a mortgage going forward. With that in mind, we're going to look at three key areas. Firstly, we'll explain some of the fancy terminology that most of the financial institutions and indeed mortgage brokers use. Then we're going to look at the different types of mortgages, ranging from high ratio through to conventional and fixed through to variable. And then we'll look at, time permitting, the three key clauses that we would want to see in any of our own personal mortgages where we're buying homes. And if we run short of time, of course, we'll drop that into the next video. Okay, so in terms of terminology, we're going to look at two things: amortization period and indeed term. So amortization period is really the life of the mortgage. Now, in one of our last videos, we talked about buying a $400,000 home using a mortgage of $380,000. Now, if we take that $380,000 mortgage using a 30-year amortization period, or as they call it in the business, a 30-year AM, then we would expect to see the balance, which started its life at $380,000, being whittled down to $0 by the end of 30 years, unless, of course, we refinanced it somewhere in the middle of its life. Now, in terms of the whole area around the word term, term is essentially that period of time where there's an agreement relating to interest rate in effect between the financial institution or bank and indeed the owner of the home. And the majority of terms will run from anything, say, from in and around 6 months all the way through to 10 years in Canada. So, for example, if we were to look at a 5-year fixed 4%, all that's telling us is for a 5-year block of time, we have an interest rate that is a fixed mortgage interest rate of 4%. And we know that that's not going to change for a whole 5-year period, regardless of whether interest rates increase or indeed decrease dramatically within the same 5-year time frame block. Okay, so secondly, we said we want to look at the types of mortgages. So with that in mind, let's look at firstly high ratio versus conventional. Now, the key distinction here is essentially the size of the down payment, and the magic number is 20%. So if your down payment is less than 20%, you're in the land of having to take out a high ratio mortgage, which means that you'll need mortgage insurance because the bank will require you to have that. And one of the biggest providers is CMHC in Canada. And of course, the mortgage insurance will get added to your mortgage on closing once you take possession of the home. Now, were you to put a down payment of greater than 20%, then you're in the area of having a conventional mortgage, and you're not required by the bank to take out mortgage insurance. Now, from a bank's perspective, one of the major rationales behind that is that the bank feels that even if there was a downturn in terms of housing market pricing, there's enough money in the deal to take pretty much all of, or indeed the majority of the pain before the mortgage ever gets compromised from a falling market. Now, another term that you'll often hear of is LTV, or loan to value. And at its very basic level, let's look at that. So for ease of explanation, let's say we're buying a $100,000 home, and we're looking at taking out a loan or mortgage to the value of 90%. So what does that mean? Well, effectively, what that means is we're putting down a payment of $10,000, and the loan to value, i.e. the size of the mortgage to the value of the home, is 90%. So therefore, we're taking out a mortgage of $90,000. And with a down payment of $10,000, effectively, that means it's a high ratio mortgage, as it's less than 20% of the value of the home, and we would require a mortgage insurance in that instance. Okay, so let's look at fixed and variable mortgages. A fixed mortgage is essentially where the interest rate is fixed for a defined period of time, referred to as its term. And as I said earlier, that generally runs from 6 months all the way through to 10 years in Canada. Now you have, as an example of that, let's say you're looking at a 5-year fixed of 4%. Well, we know that we have 4% over the course of our mortgage for the entire 5 years, regardless of what happens to rates over that time frame. Now, keep in mind, this is an aside. The cost of a fixed mortgage is driven by the bond market versus the cost of a variable mortgage is driven by essentially what happens to prime. Now, when we look at the variable mortgage, essentially a variable mortgage is a mortgage that works alongside prime. And in the last few months of making this video, you've seen prime currently sitting at 3%. So in the last few months, you've seen deals out there where you could get a variable mortgage, a 5-year variable mortgage at prime less 3/4 points. So effectively, what that means is this. You've taken out a mortgage that has a term of 5 years, essentially where the relationship between prime and what you actually pay in terms of variable mortgage will always be prime less 3/4 points. So effectively, you'll be working off, at this point in time, a mortgage costing you 2.25 points until prime changes. Now, prime can either increase or decrease over that 5-year term. So in this, so effectively, you'll find that your monthly mortgage cost can change within that term. So let's say prime went to 5% over the next, say, 2 to 3 years. Then effectively, you'll still have that relationship between prime and, in this instance, the discount of 3/4%. But prime has moved, so the cost to you now would be 4.25%, i.e. 5% prime less the relationship we have, which is a 3/4 point reduction. So it's gone from 2.25 to 4.25. So it moves with prime, and you need to have the financial wherewithal to manage these moves and still be able to pay your mortgage going forward. Now, a few final things. Firstly, is that many people, when taking out mortgages, they often look at taking out a variable mortgage, particularly when interest rates are low, and then they're looking at perhaps converting that into a fixed mortgage if they believe that interest rates are going to increase going forward into the medium term. And they'll look at locking it into a fix at that point. Just keep in mind that you should really be having a conversation with your bank up front to ensure that if you were to do that, you would get the best discounted fixed rate when you made the change from variable to fixed. Because for many banks, the interest rate that they will give you often varies depending on whether you're an existing customer, where they may not give you the best discounted rate, or a new customer where you may end up getting the best discounted rate just because they want to take you on as a new customer. So have that conversation up front. Secondly, if you need to break a mortgage before the end of its term, the subject of another video, then if it's a variable mortgage, it will normally cost you 3 months mortgage penalty. However, if it's a fixed mortgage, it'll be the greater of IRD, or interest rate differential, or 3 months mortgage penalty. And IRDs can be very expensive, so be aware. Last thing within this whole area would be, you'll hear a couple of terms out there when it comes to interest rates. One being bank posted rate, and indeed secondly, a discounted rate. Now, bank posted rate is the rate that you'd get if you walked into the bank and you'd see it advertised. The rate for 5-year fixed is X. So it's a totally undiscounted rate. Now, we compare and contrast that to what's called a discounted rate, which would be one of the lowest rates that you can get for that product in the marketplace. So you'd get a discounted rate if you walked into the bank, saw the posted rate, and then started to talk and negotiate that rate downwards. Or indeed, many people will use a mortgage broker to essentially do that for them. So the mortgage broker will find out what mortgage their client requires, and then they'll shop that requirement to many financial institutions, creating a competitive environment such that the financial institution who actually gets to service that mortgage does so because they provided a very, very attractive interest rate and some very good terms. And the second reason that the mortgage brokers tend to get used is that it requires just one credit check, and then your details are going to be shopped to many financial institutions, versus if you sat, say, by yourself with 3 individual banks, then you're looking at potentially 3 individual credit checks, which doesn't do your credit report much good. Now, view this video as merely a primer to enable you to think about what questions you might want to ask your bank or mortgage broker when you sit with them, and in no way to replace their professional advice. And of course, it goes without saying that you should, of course, sit with your own bank or mortgage broker to ensure that you dot all the I's and cross all the T's for your specific individual requirements before choosing the appropriate product for you. Can I say thanks very much indeed for taking the time to review this video. This is Eamon Kelly with Keller Williams Real Estate. Take care. Bye-bye.